All right, folks, buckle up because today's market open was a bumpy ride. We're seeing red across the board as Wall Street grapples with a double whammy: renewed tariff anxieties and growing concerns about the AI sector. I know, right? Just when we thought things were starting to stabilize. But hey, that's the market for you, always keeping us on our toes. So what exactly happened? Let's break it down. First up, the elephant in the room: tariffs. President Trump's trade policies are back in the spotlight, casting a long shadow of uncertainty over the market. Remember the good old days of relatively stable trade relations? Yeah, me neither. The threat of new tariffs on key trading partners like Canada and Mexico is sending shivers down investors' spines. And honestly, who can blame them? This kind of volatility makes it incredibly difficult for businesses to plan and invest. It's like trying to build a house on quicksand. You think you're making progress, but then everything shifts and you're back to square one. The market hates uncertainty, and right now, we're swimming in it. But the tariff drama isn't the only thing weighing down the market. We're also seeing a significant sell-off in chip stocks, and this is where things get really interesting. Marvell, a major player in the chip industry, just released a less-than-stellar forecast, and investors are interpreting it as a sign that the AI boom might be slowing down. Now, hold on a second. Did I just say the AI boom is slowing down? That's right. After months of seemingly unstoppable growth, there's a growing sense that the AI market might be getting overheated. Think of it like this. Everyone's rushing to build the tallest skyscraper, but are they really thinking about whether there's enough demand for all that space? Marvell's forecast suggests that maybe, just maybe, the answer is no. And when a key player like Marvell hints at a slowdown, the entire sector feels the impact. Specifically, at the open, the Dow Jones Industrial Average took a hit, falling 158.1 points, or 0.37%, to 42,848.49. Not a massive drop, but definitely a sign that investors are feeling uneasy. The S&P 500 fared even worse, dropping 56.8 points, or 0.97%, to 5,785.87. And the tech-heavy Nasdaq Composite? Well, let's just say it wasn't a pretty picture. The Nasdaq plunged 348.2 points, or a whopping 1.88%, to 18,204.528. Ouch, that's a significant decline, and it highlights the vulnerability of the tech sector to these kinds of market jitters. So what's behind this chip stock sell-off? Let's dig a little deeper. Marvell's disappointing forecast is the immediate trigger, no doubt. The company's first quarter sales projection, while in line with analysts' average estimate, simply didn't excite investors who were expecting stronger AI-driven growth. They were hoping for a rocket launch, but instead, they got a slow, steady climb. And in the fast-paced world of tech investing, slow and steady doesn't cut it. Investors are hungry for exponential growth, and when they don't see it, they start to panic. Shares of Marvell plummeted 18.6% in early trading, and that drop sent shockwaves throughout the entire chip sector. It's like one domino falling and taking down the rest with it. It's a classic example of how market sentiment can quickly turn negative, even when the underlying fundamentals are still relatively strong. And it wasn't just Marvell that suffered. Peer Broadcom, which is expected to report quarterly results after the market's close, saw its shares fall by 6.5%. Investors are clearly worried that Broadcom might also deliver a disappointing forecast. And then there's Nvidia, the darling of the AI chip world. Even Nvidia couldn't escape the sell-off, with its shares dropping by 3.5%. Advanced Micro Devices, another major chipmaker, also saw its stock price decline by 2.5%. This widespread sell-off demonstrates just how interconnected the chip sector is. When one company stumbles, the entire industry feels the pain. It's like a flock of birds all changing direction at once. One bird makes a move, and the rest follow suit. But there's more to this story than just one company's forecast. There are also growing concerns about overspending and overcapacity in the US AI industry. Some analysts are starting to wonder if we're building too much AI infrastructure too quickly. Are we really going to need all those data centers? Are we going to be able to use all that computing power? And what about the competition from China? Chinese companies like Alibaba are developing their own AI models that are becoming increasingly competitive. In fact, Alibaba just released a new reasoning model that it claims is on par with DeepSeek's R1, a global hit. That's a serious challenge to the dominance of US AI companies, and it's adding to the overall sense of unease in the market. It's like entering a pie-eating contest, only to realize that someone else brought a much bigger appetite. All of these factors have contributed to a significant pullback in the tech-heavy Nasdaq. The Nasdaq is now down about 9% from its record high hit in December. That's a pretty substantial correction, and it's a reminder that even the most promising sectors are vulnerable to market volatility. It's easy to get caught up in the hype and believe that a particular sector is unstoppable, but the reality is that every market has its ups and downs. And right now, the tech sector is definitely experiencing a bit of a downer. This pause in the bull rally, which started back in January, is forcing investors to reevaluate their positions and think about the long-term prospects of the AI industry. Are we in a bubble? Are we overinvesting? These are the questions that investors are asking themselves right now. Now, let's circle back to the trade war situation. President Trump has exempted automakers that comply with existing free trade agreements from his 25% tariffs on Canada and Mexico for 1 month. That's a temporary reprieve, but it doesn't address the underlying uncertainty. Trump has made it clear that he's not calling off his trade war, citing the need for more border controls. He's essentially saying, I'm giving you a little bit of breathing room, but don't get too comfortable. This kind of brinkmanship is keeping investors on edge. They don't know what's going to happen next, and that makes it difficult to make informed investment decisions. It's like playing a game of chicken with a freight train. You might win, but the consequences of losing are pretty dire. Against the backdrop of this trade uncertainty, U.S. stocks have witnessed increased volatility over the past few sessions. We're seeing wild swings in prices, and that's a sign that investors are nervous. Charlie Ripley, senior investment strategist at Allianz Investment Management, put it perfectly. We're still continuing to see headline risks from the development of tariffs on Mexico and Canada drive U.S. stock prices, and until we can get some clarity, we're going to expect some volatility there. He hits the nail on the head. Clarity is what the market craves, and right now, clarity is in short supply. The market is reacting to every tweet, every rumor, every headline. It's like a hypersensitive seismograph, picking up even the slightest tremors. Now, it's worth noting that Wall Street's main indexes closed higher over 1% on Wednesday, following Trump's announcement about the tariff exemption. So, the market is clearly responsive to these developments. But the underlying anxiety remains. The benchmark S&P 500 is close to the levels seen during Trump's election victory, and the Russell 2000 index has fallen over 7% since early November. That's a significant decline for small-cap stocks, and it suggests that the broader economy might be starting to feel the impact of these uncertainties. It's like the canary in the coal mine. Small-cap stocks are often the first to signal trouble ahead. Multiple reports have suggested that tariff uncertainty has resulted in individuals holding back on consumption and corporate executives staying put on investment decisions. That's a recipe for an economic slowdown. When people are afraid to spend money and businesses are afraid to invest, the economy grinds to a halt. And the problem is compounded by the fact that inflation remains elevated. We're in a situation where prices are still rising, but economic growth is slowing down. That's a dangerous combination, and it's something that policymakers need to address urgently. It's like driving a car with one foot on the gas and the other on the brake. You're not going to get very far, and you're likely to damage the engine. On a slightly brighter note, a report released today showed that weekly jobless claims stood at 221,000 in the week before, lower than expectations of 235,000. That's a positive sign, and it allayed some worries about an economic slowdown. But it's just one data point. We need to see more consistent evidence of a strong labor market before we can breathe a sigh of relief. Friday's key payrolls data will be crucial for investors trying to gauge the economy's health. It's like waiting for the results of a medical test. You're hoping for good news, but you know that the results could be anything. Traders now see the Federal Reserve lowering borrowing costs by 25 basis points for the first time this year in June, according to data compiled by LSEG. That's a reflection of the growing belief that the economy might need a little bit of help. Lowering interest rates would make it cheaper for businesses to borrow money and invest, and that could help to stimulate economic growth. But the Fed is in a difficult position. It needs to balance the need to support the economy with the need to keep inflation under control. It's like walking a tightrope. One wrong step, and you could fall. Comments from policymakers Patrick Harker, Raphael Bostic, and Governor Christopher Waller are due later in the day, and investors will be paying close attention to what they have to say. Every word will be scrutinized for clues about the Fed's future plans. And what about China? China's commerce minister said today that his country will not yield to bullying and that its economy can weather higher tariffs imposed by Trump, though he added that there are no winners in a trade war. That's a pretty defiant statement. China is essentially saying, we're not going to back down. We're prepared to fight this out. That's not exactly reassuring for investors. A prolonged trade war would be bad for everyone involved. It would disrupt global supply chains, raise prices for consumers, and slow down economic growth. It's like two heavyweight boxers going toe-to-toe for 15 rounds. Both fighters are going to take a beating, and neither one is going to emerge unscathed. Looking at the Asian markets, we see a mixed picture. Hong Kong's Hang Seng Index jumped 3.3% to 24,369.71 following Chinese government reports to the annual legislative session that showed a greater resolve by Beijing to boost consumer spending and other domestic demand. That's a positive sign for the Chinese economy. Tokyo's Nikkei 225 index gained 0.8% to 37,704.93. The Shanghai Composite Index advanced 1.2% to 3,381.10. South Korea's Kospi jumped 0.7% to 2,576.16, while the S&P ASX 200 in Australia slipped 0.6% to 8,094.70. Taiwan's TAIEX shed 0.7%, while the SET in Bangkok skidded 1.4%. So, some Asian markets are up, and some are down. It's a reminder that the global economy is a complex and interconnected system. What happens in one part of the world can have ripple effects everywhere else. In Europe, the picture is also mixed. At midday, Germany's DAX gained 0.4%, as did the CAC 40 in Paris. Britain's FTSE 100 sank 1%. So, again, we're seeing a mixed bag. Some European markets are doing well, while others are struggling. This just underscores the overall sense of uncertainty that's pervading the global economy. There's no clear consensus about where things are headed. It's like trying to navigate through a dense fog. You can't see very far ahead, and you're constantly worried about running into something. Okay, let's dive into some technical analysis for a moment. For those of you who are familiar, let's talk about Fibonacci retracement levels. We're seeing the S&P 500 testing the 38.2% retracement level from its recent high. If it breaks below that, we could see a further move down to the 50% level. Keep an eye on those key levels, folks. They could provide some important clues about the market's future direction. Now, I know technical analysis isn't everyone's cup of tea. Some people swear by it, while others dismiss it as mumbo-jumbo. But even if you're skeptical, it's worth paying attention to these levels. They can often act as self-fulfilling prophecies. If enough people are watching them, they can influence the market's behavior. Now, let's get to a contrarian viewpoint. Now, let's play devil's advocate for a moment. What if this AI slowdown is actually a good thing? What if it's an opportunity for investors to buy into the AI sector at a lower price? What if the long-term prospects for AI are still incredibly bright, even if there are some short-term bumps in the road? It's certainly possible. AI is still a relatively new technology, and it's going to take time for the market to mature. There are going to be periods of rapid growth, followed by periods of consolidation. That's just the nature of innovation. And if you're a long-term investor, these periods of consolidation can be great buying opportunities. Now, I'm not saying that you should rush out and buy every AI stock that you can find, but I am saying that you shouldn't panic. Take a deep breath, do your research, and think about the long-term potential of AI. It's like buying a house. You don't just buy it because the market is hot. You consider the location, the size, and the potential for future appreciation. Now, before we get too carried away with the contrarian viewpoint, let's remember the efficient market hypothesis. This theory suggests that market prices already reflect all available information. If that's true, then it's impossible to consistently beat the market. Any attempt to find undervalued stocks or predict market movements is ultimately futile. Now, I know that's a controversial statement. There are plenty of people who believe that they can beat the market. But the evidence suggests that it's incredibly difficult to do so, especially over the long term. So what does that mean for us? It means that we should be cautious about trying to time the market. We should focus on building a diversified portfolio and investing for the long term. It's like planting a tree. You don't expect it to grow overnight. It takes time, patience, and consistent care. So, what's the takeaway from all of this? Well, it's clear that the market is facing some significant headwinds right now. Tariff uncertainty and concerns about the AI sector are weighing on investor sentiment. Volatility is likely to remain elevated in the near term. But it's also important to remember that the market is constantly evolving. Things can change quickly. A positive development on the trade front or a strong earnings report from a major AI company could quickly turn things around. The key is to stay informed, stay diversified, and stay patient. Don't let emotions guide your decisions. Stick to your long-term investment plan and don't panic sell during market downturns. It's like weathering a storm. The clouds will eventually part and the sun will shine again. Now, I want to hear from you. What are your thoughts on the market? Are you worried about tariffs? Are you still bullish on AI? Let me know in the comments below. And don't forget to like and subscribe for more market updates. Thanks for watching, and and I'll see you next time. Remember to do your own research and consult with a financial advisor before making any investment decisions. This is not financial advice, and I am not a financial advisor. I'm just here to share my thoughts and insights on the market. Now, let's have a conversation in the comments. What are your biggest concerns about the market right now? What sectors do you think are poised for growth? I'm eager to hear your perspectives.